Welcome! Today, we're going to deconstruct the blueprint for building a much more tax-efficient financial life. We're moving past just filing taxes and getting into strategic design, breaking down the core mechanics that people use to protect and grow their money.
So let's start with a foundational idea that honestly changes everything. Mastering tax strategy isn't really about finding some secret loopholes. It's about understanding that the tax code is literally designed to reward certain activities. Things like creating jobs, providing housing, and investing in the economy. So the real key is to align your own financial structure with those built-in incentives.
So, our blueprint is broken down into 5 key sections. We're going to start with the legal structure, then move to income and expenses, then take a look at long-term wealth transfer, and finally, we'll tie it all together with the most important principle of all. Okay, let's dive into this. The very first part of our blueprint is all about creating a legal shield. This is, and I mean this, the non-negotiable first step. It's what separates your personal assets from your business liabilities, and it forms the bedrock of your entire financial house. So once you've formed a legal entity, say an LLC, these 3 steps are absolutely critical. First, you get an EIN. Think of it as a social security number for your business. Then you use that number to open a dedicated business bank account. And from that moment on, all business income and expenses flow only through that account. This strict separation prevents something called commingling, which can completely destroy your liability protection if you ever get sued. All right, so with that legal shield in place, let's look at the engine of the blueprint, how you structure your income, and more importantly, how you actually pay yourself. This is where we can create some really significant tax efficiencies. And here is a core mechanism for business owners. See, as a sole proprietor with $100,000 in profit, that entire amount gets hit with the 15.3% self-employment tax. Ouch. But by electing S-Corp status, you can split that profit into a reasonable salary and a distribution. Now, only the salary is subject to those payroll taxes. The distribution isn't. This simple structural change can mean huge tax savings. In this case, over $9,500 on the exact same profit. Now, the concept that makes this whole strategy work and keeps you out of trouble is the reasonable salary. You can't just pay yourself a $1 salary and call it a day. The IRS requires you to pay a wage that's comparable to what other people in your industry, in your location, and with your experience would be earning. Getting this number right is the key to unlocking the tax savings of an S-Corp without raising any red flags. So with our foundation and our engine in place, we can now add the tools that really optimize the system. This section is all about strategic deductions. These are the incentives the tax code provides to business owners to get them to invest back into their own operations. For anyone working from home, the home office deduction gives you a clear choice. You've got the simplified method, which is super easy, $5 per square foot, capped at $1,500. But then there's the actual expense method. It requires more record keeping for sure, but it often leads to a much, much larger deduction. You figure out the percentage of your home used exclusively for business and apply that percentage to your actual housing costs. We're talking rent, utilities, insurance, the whole shebang. And now for one of the most powerful business deductions available, bonus depreciation for a qualifying vehicle. This provision can let you take an immediate 100% write-off of the vehicle's cost in the very first year you start using it for business. So instead of spreading that deduction over, say, 5 years, you get the entire benefit right up front. So what kind of vehicle qualifies for this awesome accelerated deduction? Well, typically it's going to apply to heavier vehicles. Think of SUVs, trucks, and vans that have a gross vehicle weight rating over 6,000 pounds. And this is crucial, the vehicle has to be used more than 50% of the time for legitimate business purposes. Okay, let's look at the final piece of the structure. This isn't about your yearly income. This is about the long-term game, transferring wealth from one generation to the next with as much efficiency as possible. The most important thing here is to understand this term, step up in basis. This might be one of the most powerful and yet widely misunderstood provisions in the entire tax code. It's a mechanism that can legally wipe out decades of capital gains tax for your heirs. It's huge. So to see this in action, just imagine a parent buys a home. Their cost basis is $100,000. Now, over many, many years, that property appreciates a ton. By the time the parent passes away, its fair market value is now $500,000. That means there's a $400,000 unrealized capital gain just sitting there. So, when the child inherits the home, the step up in basis rule kicks in and automatically resets their cost basis to the fair market value on the date of death. In this case, $500,000. Poof! The tax on that $400,000 gain is essentially forgiven. And here's the result. If the heir turns around and immediately sells that home for its current value of $500,000, their taxable gain is zero. Nothing. By simply passing the asset on at death, the family can save what could have been tens or even hundreds of thousands of dollars in capital gains tax. So we've covered legal structures, income strategies, deductions, and legacy planning. But what's the master key? What's the one thing that holds this entire blueprint together and actually makes it all work? Well, it all comes down to a fundamental shift in mindset. You see, most people are reactive filers. They scramble together their documents in April just to report what already happened last year. Proactive planning, on the other hand, is a year-round activity. It's about designing your financial decisions, from how you buy a car to how you structure your business, with the tax implications in mind before they ever happen. One is just reporting history. The other is about creating your financial future. So, the crucial takeaway here is this. The tax system isn't something that just happens to you. It's a system with rules and incentives that you can strategically engage with. Understanding these mechanisms gives you the power to build a more resilient, more efficient financial future. So the real question is, are you just going to be a spectator reporting the score, or are you going to get in the game and actively play to win?